Ladies and gentlemen, welcome to another live webinar with us from Nova. And today we're going to be talking about something really exciting. It's about how to build a passive income portfolio. Many of you probably have dreams of living the luxury life or maybe maintaining your lifestyle even while after you have retired. And we're going to have a very special guest if you've been joining us in our live webinars. He is no surprise to you. He is none other than Kar Yong, a professional trader. And typically, I speak to him about Forex and CFD. But today, I know he's been doing stocks trading as well. So this comes as a pleasant surprise for me as well that Kar Yong is here and here to talk about passive income portfolio. And let me just do a refresher on what we will be covering today. Kar Yong will be sharing with you how you can build a passive income portfolio for your retirement with just $1,000 of capital. Very interesting indeed, all right? And he will go over key points like what is a passive income portfolio and how to build a portfolio that pays you even 30 years in the future. Yes, I think I need that. Sign me up. And he will also touch on the tools you need to help automate the entire process. It just gets better with each key point. And Kar Yong should be no surprise to you. It's not a new phase. Kar Yong has been doing webinars with us for quite a few years now. He started trading at the age of 21 with a small capital of just US 500. After two years of Forex trading, he was able to increase his capital by 2,600%. And since then, Kar Yong has been featured in our webinars as well as on Channel News Asia's Money Mind and awarded the most popular FX trainer in Malaysia and the top Forex analyst in Asia by WikiFX in 2019. Having coached hundreds of traders across Southeast Asia, Kar Yong believes that anyone with the desire and the right mentality can succeed in trading. And Kar Yong, if you're all set to go, I can hand the reins over to you. Kar Yong.
All right. Cool. Okay, I'll turn on my webcam. Hopefully you guys can see me clear.
Yeah, we can see you and we can hear you.
Right. Cool. Okay, so thanks again for inviting me to be giving me this opportunity to share with you guys. Okay, so we'll get started and dive straight into today's topic. Today's we'll be sharing with you how to build a passive income portfolio. I'll be, of course, talking about some of the principles, the frameworks to help you create and craft your portfolio and design a portfolio in such a way that it's like the title suggests, passive income, right? Which means you do one thing well and you're going to reap the rewards and the benefits of it in the future without doing much after that. Okay, so that's the whole idea of passive income. Okay, so very quickly, today's objective over here is we're going to touch on what is dividend investing, which is essentially what we're going to use in terms of the principle of dividend investing to build up the passive income portfolio, okay, and why you definitely want to build a dividend portfolio for yourself and of course for your family. And I always use this term called income legacy, because when you craft a dividend portfolio well at this current stage, it can actually last you even after, touch wood, you pass on. Okay, and you want to pass on this portfolio to your next generation, because that's the whole idea about passive income. Okay, we're going to definitely talk about the mindset to have as a dividend investor, because I would say the approach toward dividend investing is going to be slightly different towards short-term trading or even Forex trading. Okay, so when you're approaching trading, you need to have a certain mindset. And of course, if today you're approaching it from a perspective of building a passive income portfolio, you need to have a mindset of a dividend investor, right? And this is going to be very crucial, okay, because if you do not have the right mindset, your portfolio won't see success, right? So I'll touch on that as well. And last but not least, a lot of times people have the misconception or misunderstanding that in order to build your first dividend portfolio, you need to have a huge amount of capital. Okay, that's not true already in today's context, because I want to show you in today's sharing session as well you can actually start with just $1,000 capital, right? And I believe most of you who are attending today's sharing session would have that capital ready to invest in. Okay, but don't get me wrong, of course, $1,000 today can't make you financially independent or financially free. But I want to stress upon that you can get started with just $1,000, and from there you start to build up that capital and start to build up that portfolio into the future, where you'll be able to be enjoying your financial independence, right? So follow me throughout this sharing session, okay, and you actually will be able to achieve all this objective by the end of this. Okay, now very quick one here. Let me give me a minute to very quickly introduce myself. Okay, so that for those of you who are first time here joining us, at least you know who am I, right? So my name is Kar Yong. I started trading in the FX market since 2012, more specifically in June. Of course, I have my ups and downs, right? Tried out many different methods through trading and investing in the FX market, in the commodities market, as well as in the equities, the US market. One of the worst losses I have is I blew off a $20,000 account, but of course that come along with many valuable learning lessons that built me to who I am today as a trader and investor. Okay, and for me, I turned full-time trading, investing, as well as sharing my experience by the end of 2015, right? So there's a couple of years where I think every trader and investor will need to go through to really acquire the ability to trade and invest. Okay, so and today I really enjoy sharing my experience, what I've learned, what I know about the market with fellow traders and investors, right? So that's exactly what we're doing in today's sharing. Okay, of course, before COVID, I've done a lot of physical offline events across Southeast Asia. Okay, some of you perhaps have also participated in one of those physical sharing sessions. And then since COVID, everything turns online, yeah. Hopefully, starting this year, we are slowly transiting more back into physical event, because to me, I think the interaction level is very different comparing physical offline events and online webinars, right? Because online webinars, you can see me, I can't see you. I don't really know if you're getting what I'm trying to share, but in terms of physical events, I can see whether you get it or not, and the interaction level is definitely higher from there. Okay, so that's a quick one about me. Now, you might be thinking, right, dividend investing, perhaps some of you have heard about this term before, or even joined some other webinars, sharing, or even workshop, right, about investing before, okay? So you might be thinking, is today's sharing gonna value add and benefit you, right? Is this for you? Now, I want to quickly also highlight that, everyone, okay, I want to stress everyone, no matter whether you're young, you're just graduated, or you're currently working or semi-retirement, I think one of the most important aspects that I regretted the most is I did not kickstart my dividend portfolio earlier, right? So no matter what stage you're at right now, I strongly believe that everyone needs to have a portfolio. Okay. Now, of course, depending on the stages of life that you're in, the objective and the intention of you building a portfolio might be different. So if you're very young, maybe still undergraduate or just graduate recently from uni, transiting into the workforce, then your intention and the objective of your dividend portfolio will be to help you secure your financial independence down the road. Okay. Now, if today you are perhaps semi-retirement or even into your retirement age already, then this dividend portfolio is still important, but your objective and intention would not be building it for only yourself, but actually more towards maybe your future generation. And that's what I call legacy income. Okay. So I strongly believe everyone needs it, right? Whether you are young or towards the semi-retirement age, right? The difference here is just the intention and objective. Okay. And again, you might hear of this term for quite a few times, about passive income. So what exactly is passive income, right? A lot of people have that misconception and think that, oh, you don't need to do anything and therefore you just collect money, okay? That's not the entire picture of passive income, right? The true definition of passive income is you still need to put in the work, but you want to put in the work once and do it well once, in such a way in the future you do not need to do so much heavy lifting anymore. Okay, so there are many alternative sources towards passive income, right? You can have an intellectual property. For example, if today you're a well-known singer, Okay, you can record your song, and then as it sells, you get a certain royalty, right? So that's what we call passive income. Okay, you can start a business that generate passive income for you, but of course those are not as easy and not accessible to everyone. Okay, the beauty about dividend investing or getting your dividend portfolio out, crafting it, investing into the market, is actually one of the easiest and most accessible source that everyone can achieve. Okay, so the idea of today's sharing is, so I want you to see, number one, the importance of dividend investing to build your passive income portfolio, and number two, hopefully I'm able to inspire you, how you can actually get started with a small amount of capital, how easy it is to actually get started in today's context, so that you can start early, leverage on the power of growth and compounding, right? So whether you're building it for yourself or you're building it for your next generation, I think that's very important. Okay, so this is actually for everyone, yeah. Now, so what is passive income portfolio, right? What exactly is dividend investing? Now, you might again hear of this term before, but I just want to put it out so that we are all aligned in the same definition, right? Because everyone understanding of dividend investing might be slightly different. Okay, so what is dividends, right? Dividends, if you put it into a layman term of understanding it from a business perspective, okay, dividends are basically the profits that is given to you by the companies that you're invested in. Okay, so you can see it as quote unquote profit sharing. Okay, so in a way, the simplest example I can give you is all of us knows about Apple, right? iPhone. Okay, so the idea over here is that if today you invested into Apple and you're Apple's shareholder, no matter how small it is, when at the end of the financial year, Apple announced its profits and announce, how much of a percentage the profits is going to give back to its shareholder, you're going to get a small pie of it. Okay, so if you think of it, every day when Apple Store sell off an iPhone, sell off a MacBook, sell off a Mac, okay, or even whatever products and services that Apple benefit from, you as a shareholder, when you invested in Apple, you get a small pie of it. Okay, but you literally did nothing, right? You do not need to go to Apple Store to sell the iPhone. Someone is doing that for you. You don't need to design the next product for Apple. Someone is doing it for you. Okay, but what you need to do is to make that decision to invest in Apple. Okay, so that's exactly what dividend investing really is, right? You are actually investing in a company that in return profit share with you whatever market profits that it made. Okay, so as we invest in companies that pay out dividend, right, as I mentioned, you're owning a small portion of the company, no matter how small it is, and we're getting a cut from the profits that's generated by that company. Okay, so just now I mentioned about Apple. Okay, but let's go into a little bit more detail so that you can see the numbers, right? Now, Apple Incorporation, ticker symbol AAPL, actually pays out a 22-cent quarterly dividend per share. Now, what exactly that means to you as a dividend investor is that if you're a shareholder, you own one share of Apple, okay, every 3 months, Apple will pay you 22 cents as of today. Okay, so if you times that into a year, okay, so you just basically multiply by 4, because in a year we have 4 quarters, that's about 88 cents. Now, Apple is not the best stock to be buying for dividend investing, but Apple is one of the most common company, therefore I use it as an example. Okay, so in other words, if today you buy one share of Apple, okay, every year you are collecting about 88 cents, right? Now, 88 cents to you sounds not much, right? Not attractive, okay, but that's only one share, right? And I mentioned Apple is not the best company to be investing for a dividend, for a passive income portfolio, but it's one of the most common company, and therefore I just use it as an example. Okay, so this is what it means by dividend investing, right? You don't do anything much after you buy into Apple, but what you need to do is to do it well once, which means that you are actually making a decision on whether to buy and invest into Apple. Okay, so that's the decision you need to do. Once you invest in that, you do nothing else, and it pays you money on a quarterly basis, right? So that's what we call passive income. Okay, so just now I highlighted, right, it doesn't look much because Apple is actually not one of the best dividend company to be investing in, right? Apple is still growing, it's not paying out a lot of dividends, and therefore if today you're building a passive income portfolio, you would unlikely gonna be investing in Apple. Okay, So that's the idea of what exactly dividend investing in, right? Now that's important because to build a passive income portfolio in terms of the principle of dividend investing, you need to first know what exactly is dividend. Okay. Now there are a few key terms that, you know, as we talk about, we might mention it, you might come across in your journey of building a portfolio. Okay, so I just want to put it out here so that you understand what it means. Okay, so first term here that you will come across quite frequently is what we call dividend payout. This is exactly just how much you're receiving as dividend. Okay, now usually this number is reported on a quarterly basis. Okay, so you need to check and kind of like reference to it, right? Is the company reporting it on a quarterly basis, or is the number that you're looking at is on a yearly, annual basis? Okay, that's important because if it's quarterly, you need to times 4 to kind of get the number in a year, how much dividend you're getting. Okay, so that's the most straightforward one, the dividend payout, right? How much money you're receiving as a dividend. Now, the second term that you need to know is called dividend yield. Now, there's a little bit of formula over here, but most of the time, platforms, websites do share with you what is the yield. You do not need to calculate yourself, but you need to understand what it is. Okay, so dividend yield is basically just taking the formula of the dividend payout divided by the current price of a stock. Okay, so over here I give you an example, right? Apple dividend is about 88 cents per year. The price of Apple as of last recorded is about 165, and if you just do that formula, 88 divided by 165, that's about 0.5%. Okay, again, that's why I say Apple is not the best dividend stock to be owning. Now, dividend yield, a lot of times, one of the most common mistake I see a lot of dividend investors do is they put too much emphasis on dividend yield. They focus so much on dividend yield in such a way that they look at the company's dividend yield and say that, oh, this company, the yield is 5%, is 8%, is 10%. It's definitely a good dividend. Okay, not necessary. Okay, now it's a good benchmark, but you do not want to buy and invest into a company just because it has high dividend yield, right? We'll talk about all this as we progress, but you just need to understand for now what dividend yield really is. Okay, now another term over here is payout ratio. Okay, now this to you as a dividend investor is very important. Okay, so payout ratio again is a formula, is calculating based on the earnings, the profits that the company made, how much is it used to pay out as dividend to you. Okay, so for example, Apple made about 57 billion in 2020. That's their net income, the profits. Okay, they paid out about 14 billion. Okay, so again, if you use the formula to calculate 14 out of 57, that's about 25%. Now, again, Apple, as I mentioned, is still growing, right? It needs some money to do development, R&D, etc. So it's actually only giving out about 25% as dividend. Okay, so you want to take note of this figure, because if today a company's payout ratio is too high, let's say about 70%, 80% payout ratio, okay, what this means is that the company profits, 80% of it is actually used to pay you as dividend. Now that might not be a good thing because there is little room left for the company to grow, because it pays out a lot of our profits, right? Nothing left, not much of our earnings and profits left to grow and develop. Okay, so you want to balance it out. Okay, not too high, not too low. Okay, so that's about payout ratio. We'll talk a little bit about that as we progress as well. Now, the next term, the last term here that we'll talk about is dividend growth. This to you is one of the most important metric if you want to build a passive income portfolio. Okay, not dividend yield, but payout ratio and dividend growth. Now, dividend growth is essentially the percentage of growth in terms of the company's annual dividend. Now, I'll give you an example again using Apple. Okay, so from 2019 to 2020, Apple grew its dividend from 75 cents to 795 cents. And of course, after that, it increases to 88 cents, right? So you can see consistent growth in the dividend year on year. Okay, so that's a 10% dividend growth. Okay, now why this is important is because you want to be investing into companies that is consistently growing its dividend, right? And think about it. Today you invest in a company, maybe the dividend is only paying you like Apple 75 cents. But if it's consistently increasing its dividend, okay, in the future you might be collecting $1, $2 from the same company that you invested maybe back in 2019. Okay, and that is again what we meant by passive income, right? You're making your money work smarter and harder for you. Okay, so dividend growth as a dividend investor is very, very important. Right, so now let me stress a little bit into why dividend investing, why you want to build your passive income portfolio. Okay, because if today you invest in companies that pays you dividend not only today, but maybe 10 years down the road, 15 years down the road, 30 years down the road, okay, what you're essentially doing is you're making your money work harder and smarter for you, as compared to what? As compared to maybe you're putting it just in your savings account, right? And the money is really not working hard. Okay, and with today's inflation rate in the US is about 7 and above. Okay, the bank is paying you in terms of interest maybe 1% or even lesser. You're actually losing in the value of money if you just put it in your savings account. Okay, so you need an alternative, and dividend investing, building a portfolio over here, is the way to go. Okay, as I mentioned, you do it once, you do it well, it pays you forever. Okay, that's the definition of passive income, right? And the beauty of this versus trading is that you don't need to regularly monitor the market every day, every week, or even every month. Okay, as the term, I want you to emphasize and focus on building a passive income portfolio is basically doing something once, doing it well, and you want it to pay you forever, right? Which means you don't want to be actively having the need to monitor the market, to monitor your portfolio, and then trading in and out. That's not what we want to do, and that's not the emphasis of a dividend investor. Okay, so I hope you guys are following so far. Okay, now I also want to stress upon the power of compounding. Okay, because if today you want to invest into, or you want to construct, okay, a passive income portfolio, it's not gonna be a short-term thing. It's not gonna be like overnight you become financially independent. Okay, you need to look at it from a long-term perspective. Okay, that's again why I say income legacy. Okay, so you need to write on the power of compounding. Now, this table over here just show you based on a simple 4% interest rate. Okay, now you can see if on year one you started with 100,000, just based on 4% interest. Okay, by year 10, that's about 148,000, right? Which is about 50% of it. Not fantastic, but I want you to see this is just based on 4%, right? If today you build your portfolio well, you're definitely going to benefit more than just 4%, right? It's going to be higher from there. Okay, this is another table to share with you if today you not only invest in dividend stocks, not only invest in the portfolio itself, but you're investing in what we call dividend growth. Okay, and you're going to reinvest the dividend that you collected from it, which means, you know, you don't really take your dividends out and go and spend it. Okay, you can do that, but if today you choose to reinvest, that means the dividend that's paid out to you, you collect that, invest it into the company again. Okay, within the same time period, you actually double your portfolio. Okay, so from zero, which is the starting year, is 100,000. If you do that consistently with just again 4%, okay, that is gonna give you about 200,000 by the end of year 10. Okay, so this is the idea of why everyone, okay, and I stress again why it's so important that everyone needs to build one. Okay, because again, it's one of the easiest, most accessible way to your passive income, right? So how to build a portfolio? Okay, so before we go into the technicalities of, you know, what you need to look up for, what are some of the companies that I'm personally looking at, sort of things like that. Okay, I want to talk about the mindset. Okay, this is very important because if you have been trading the market, if you have been maybe doing other forms of investing, right, whether it's value investing, growth investing, the mindset towards dividend is slightly different. Okay, so first thing first, this is definitely not a get rich quick solution, right? So you can't come into, you know, the idea of, oh, I want to build a portfolio and then next year I'm going to retire and I'm going to be rich. Okay, that's not going to happen. Okay, you're building an income legacy. So as I mentioned, if today you're young, you're building it for yourself. Okay, and of course, moving into next generation as well. If today you're into semi-retirement or closer towards retirement, then you're building it for your family, okay, or maybe for your next generation in mind. Okay, so focus on the dividends that you're going to receive. Now, a lot of times people are drawn into the stock price. Okay, so I repeat this. A lot of times people are drawn into looking at and focusing at the stock price, right? Because that's like excitement, right? Every day the market is moving, okay? But today, if you are set to build up your passive income portfolio as a dividend investor, you want to focus primarily on the dividends that you're going to receive. Now, this mindset shift is very important because if you're going to focus on the stock price, you are more or less trading, right? Your emotions are going to follow up and down together with the stock market. You do not want to be in that situation, at least if you're coming in from a dividend investor point of view, okay? So focus on the dividend, okay? Each stock or asset that you put into your portfolio is like buying and investing into a quote-unquote money printing machine. You need to have that mindset. Okay. Now, when I mean money printing machine, it literally means that, right? Because whenever the company pays you dividend, it's like printing money for you, okay, but on a quarterly basis, right? So when you are looking at that from a mindset of a dividend investor, right? So give you two options over here. Option A, okay, if a stock is at $100 price and it pays you a dividend of 3% per $3 per share, right? So if you put that into yield, that's about 3% yield. Okay, what it means is that today, if you invest in a company, you need to pay $100 to acquire one share of this company, and every year you're gonna collect $3 back. Right? So if you put yourself in the money printing machine mindset and perspective, right, what it means is that you buy a machine that is going to be priced at $100. So you pay $100, you acquire this machine, and every year this machine will print you $3. Okay, and the focus here, of course, is perpetually, right, which means forever into the future. Okay, so that's again one of the aspects of how we're going to select companies that has the ability to do that. Okay, now what if option B is that if this machine right now is $80, okay, but it has the same ability to print you $3 every year, okay, that's a 3.75% yield. Now, if I give you these two options on the table, which would you choose, right? I would say 100% of the people will go for option B. Okay, it makes sense, right? Because it's cheaper, you pay a lower price to be able to actually get the same result of $3. Okay, so now if you think about this and you put this into the perspective of the stock market, the price of a stock is always fluctuating up and down, up and down, up and down. In 2022, a lot of stocks has already dropped. Right, the market has retraced, the market has corrected. Some might even call it a bearish market. Right, so from an dividend investing perspective, you realize that this drop in price is actually a golden opportunity for many of us because you can see it as a discount. Okay, the fundamentals of the company did not change. The company, if it's still very strong and it's paying same dividend or even increasing dividend, then isn't that a super sale or discount period for us to be investing and buying into them? Okay, so I want you to see from this perspective, right, where many traders see, wow, from $100 drop to $80, they start to panic and things like that. But from a dividend point of view, from a dividend investing point of view, if this company is still good, the fundamentals are still strong, this is a solid opportunity to buy more, right? Because right now you can buy a cheaper price with the same effect of printing you $3 per share. Okay, so that's the idea I want you to see, right? I want you to adopt that kind of mindset when you're crafting your portfolio. Okay, so this is the part where again we talk about it, right? So given nothing has changed fundamentally except for the price, we always choose option B, right? So that's the mindset you want to have. Okay, now over here, of course, I'm not saying that every stock that drops, you want to buy into it, right? That is not the way to go. But I'm saying that if the company's fundamentals are still strong, okay? So there are a couple of things that we want to focus on, okay? Number one, we want to focus on fundamentally strong companies, right? What does this mean? It means that while the prices of this company can come down in the stock market, okay, businesses are still doing well, right? The company is still making money, is still profiting from it. Okay, the net profit is increasing and things like that. Okay, so that's what we mean by fundamentally strong companies. Okay, and we don't really time, or I would say we don't really need to time our purchase or investment perfectly. Okay, that's for traders, and if you want to do trading, right, timing is important. But if today you are constructing your dividend investing, you don't need that. Okay, now you can incorporate some element of timing to purchase the stock, purchase your investment, but you don't need, I would say you don't need to put too much emphasis on that, right? If you have the ability to do it, better still, okay? But if you don't, it's perfectly fine, okay? So what we want to do is we just invest and construct a portfolio, but when the market is coming down, right, with a proper portfolio management, we can then take advantage when there is this discount, which is exactly what's happening right now in 2022, okay? And again, that's why I think this is actually a golden opportunity for many of you guys out there who haven't started yet to be getting started right now, right? But of course, with proper knowledge and skill set, right? That's why this sharing is actually designed. Okay, now on top of all those principles that I talk about, I also want to add on my personal mindset and approach when I build up my own dividend investing portfolio. Okay, so the first one over here is I need to be very clear that when I use the money, okay, I don't leverage, right? I use cash, right? So the money I use to invest and purchase the stock in a way where I want to use it for crafting and building my passive income portfolio, okay? I have the mindset where this money, I'm never intending to take it back, okay? At least from a short to medium term or even potentially forever. Okay, so think of it as if today you want to buy and invest into a stock or a money making machine, right? You're basically buying it for lifetime, perpetual, okay, all the way into the future and even pass it down to the next generation. Okay, so if today if you have in mind, right, that you need the money maybe in the next 1 year, next 2 years, then maybe this money is not best intended to build up this portfolio. Okay, so this is the mindset that you need to have, right? Again, money you use is when money you don't intend to take back, okay? At least for the short to medium or even potentially forever, okay? And when I buy into a particular company, okay, so for example, over here we are using ABBV, right, which is ABBY. So if I buy into this particular company at $169.50 today to collect $5.64 dividend, okay, I'm not focusing on the price movement of 169.5. Now, it's good if the price stock from 169 increase to 170, 175, 180 in the future, right? That's a bonus, okay? Psychologically, that feels good, okay? But what I'm focusing on is the $5.60 that I'm collecting perpetually, okay? So in other words, when I invest into this particular company, I've done my research. I know that this company has strong history of dividend, is consistent in its payout. There's a growth in the dividend. And what I'm focusing on is I pay 170 to buy this machine, and 30 years down the road, 100 years down the road, okay, it's gonna pay me $5.60 and more, okay, because the dividend is gonna increase, right? And that's what I'm focusing on, okay? Now it might sound like, well, I need a lot of years to recruit my $170, right? If every year is only paying 160. It's true, but again, go back to the mindset. I don't need this $169 today. I'm putting in such a way that 50 years down the road, 100 years down the road, I'm going to collect back faster and faster because of the compounding effect. And if this company is consistently growing its dividend, it's definitely a solid company. The price stock is definitely going to increase. Okay, it's not going to stay at 170, right? And in the future, if this stock is $200, okay, I could have easily recruited my investment to benefit from the capital gain. At the same time, I've been collecting all this dividend. Okay, so that's the mindset I'm approaching, and I hope, okay, this is very important, and I hope you guys can get it. Okay, can actually take this mindset and put into practice for yourself. All right, now in the short run, the price stock is always going to be fluctuating, right? So if this particular stock price from 169 drops to 140, but nothing has changed fundamentally, the company is still making money, still paying consistent dividend, is still growing its dividend, what would I do? I would actually decide if it's at a better price. I would want to then look, okay, if I have spare cash right now, what would I do? I would want to buy in more. Okay, and right now I'm actually paying a much lower price to collect 560. Okay, so that's the mindset I want you to be able to adopt, and that's the mindset you need to have as a dividend investor. Okay, so see it as a discount. Okay, but of course the condition here, as I mentioned, is that this company is solid, right? It's still good. Okay, so we'll talk about what are some of the conditions to consider. Good. So I hope so far so good. You guys are following, yeah. Okay, now give you some math. Okay, what is a good dividend yield in terms of average? Okay, now if today you do passive investing in terms of just buying the indices, right? The dividend yield for S&P is about 1.3, okay, which is not a lot. Okay, so that's like if today you don't know anything about dividend investing and you just do passive investing into S&P, you're actually collecting about 1.3 per year. Okay, so if today you want to build a portfolio for yourself, you definitely want to be better than that, right? Only then it makes sense. Okay, so the portfolio that you want to build, your target here is at least 3% per year. Okay, but of course we're gonna go more than that. But the basic minimum here is you need to at least achieve 3%. Okay, and what you want to also focus on is to grow your capital. Okay, which means the price of the particular stock. Okay, by an average of about 10% per year, which is very doable. Okay, but of course this year the market is dropping. Okay, which is a good timing to be looking at investing, right? Because everything is at a discount, and when the stock market recovers, which it will always recover, the question is when only. Okay, how long is the correction going to be? Because the market is always going to be recovering. Okay, so when it recover, that's where you're going to benefit the most out of it if you time it a little bit better. Okay, so if you average out, that will give you about 13% to maybe 15% return per year, which is great, right? And I want you to know that you did nothing much more. Okay, you just do it once, you do it well, your portfolio grows by average about 13 to 15% every year. That's fantastic, right? Okay, so if you do this, with a simple compounding formula, that's about 5 years for you to double your entire capital. Okay, so this is the part where some people might say 5 years sounds very long. Okay, but again, put this into perspective. Okay, if today, okay, even if it's slightly longer, we put it 10 years, 15 years, right? You want to compare it to something, right? So 10 to 15 years to give you or move you closer towards financial freedom, financial independence, to build your legacy income, versus having to work 40 plus years only to retire with not much savings. Okay, 10 to 15 years doesn't sound long after all. Okay, and as I mentioned, if you are approaching this with the right mentality and mindset, you're not only building it for yourself, but you're building it for a legacy. Okay, so with all that, okay, I hope you're getting and you're following me, right? Why I invested time to talk about all those is because those are the foundation. Okay, a lot of times people want to jump straight into like, oh, what stock to buy, what are some of the metrics to look at and things like that. That is nice, is important, okay, but you don't have the right foundation, you don't have the right mindset towards dividend investing, towards a passive income portfolio. All those sexy stuff that's nice to have, it's not gonna last, right? So I hope you can see the importance of that. Good. Okay, so now how to get started with $1,000, right? Of course, some of you might have more capital that's ready to invest into that. but I'll just put it as 1,000, right? Of course, if today you have 10,000, you have 20,000, you have 50,000, or even 100,000, you can actually scale on that, okay? But 1,000, I believe, is an amount that majority of the people, if not everyone, will be able to at least save up and start their passive income portfolio, right? Start their dividend investing journey. Okay, so how to start, right? My suggestion over here, again, these are not direct recommendation, but these are suggestion. Okay, so based on $1,000, okay, what you want to do is you want to allocate about 20% of that, which is $200, and 15% of that into SDIV and SPHD respectively. Now, what are these two? These are ETF, exchange traded funds, right? And in short, basically these two particular asset, right? I don't call it stock, they're not stock, but these two particular asset, inside it, there are a selected list of stocks that is managed by the ETFs itself. Okay, so why this two is because it helps to manage the volatility of your portfolio. Now, if today you do individual stock pick, which we will, okay, if your entire portfolio of $1,000 are all based on individual stock pick, then your stock portfolio is going to be a little bit more volatile, right? Because depending on how the stock price is moving, your portfolio is going to follow suit, okay? And that's not going to be beneficial for your psychology, okay? So what we want to do is we allocate about 35% of this $1,000 into these two ETF, right, to help you manage a little bit in terms of the volatility. Okay, now these two ETFs also pays off dividend, okay, and that's why we are looking at this two. Now the remaining 65%, we're going to split it into 5 stocks, which we have about 13% allocation each. Okay, now why 5? Not more, not less, right? Because 5 stocks is going to be a good balance as a suggestion. Hey, if you have too many individual stocks, if you have more capital, right, that makes sense. But if today you are only starting with $1,000, you do not want to spread out your resources too much. You want to focus, right? So 5 is a good number. Okay, so with this structure in mind, okay, with today's platform and today's technology, you're able to do what we call this, you don't need to buy one share specifically, right? Today's platform, today's technology allow you to buy, we call it split, right? Which means if today you want to allocate, let's say $100 or $200 into a particular asset, okay, you can do that. So if the asset price is maybe $300, you actually can buy in less than 1. Okay, so that's the idea of it. Okay, now let's go into a little bit of a technicalities right now. Okay, what I'm going to show you here are some of the tools that are personally designed to facilitate the entire process of dividend investing and how to build this portfolio. Okay, at the end of today's sharing, I'm going to share with you how you can get these tools as well, right? These are all the tools that I've designed personally for me to use to facilitate my own processes as well. Okay, one of the things that I look at is what we call the macro and sector analysis, right? We look at the big picture first. So this would tell me which particular industry, which particular sector is going to be performing better during this period of time. Now, because I only want to focus on 5 stocks, okay, I want to choose the best among the entire stock market, and I need to do some filtering. Okay, so that's where we go top down. So from a sector analysis perspective, this was done in April, which is still valid right now. Okay, the sector to focus, as you can see on the right, is energy, staple, and services, right? And therefore, if I'm going to select the stocks to be investing in as I'm building this portfolio, I'm going to be choosing stocks maybe coming from this 3 sector. Okay, now another tool that I have over here is to look into the various ETFs and see which one is performing the best. Okay, so you can roughly see from this screenshot here, we look at the weekly changes, monthly and the quarterly change, and we see which ETF actually rallies the most. In this case here, I highlighted 3, which is energy, healthcare, utilities. So again, if I want to select some companies to be investing in, I want to select maybe from this 3 sector. Okay, so that's the idea of top-down analysis. Okay, so you know where to deploy your resources, you know where to focus on. Okay, you won't be lost. Okay, so this is the processes, the steps that I'm using, right? Hopefully you guys are following through. Next, okay, what I've done also, I've compiled an entire list of dividend stocks, okay, that I might be interested in, right? I call this spreadsheet the dividend shopping list. Inside there's a couple of, I think, close to 70 plus companies that I've shortlisted. Now, not all of them are investable, okay? They do pay out dividend, they're attractive in this dividend, but not necessarily strong all the time, right? Some companies might fall out, some companies might perform better and things like that because of economic changes, right? Depending on how the business do as well, okay? But this gives me a quick list into which stock I want to focus, okay? So usually the process goes by, I want to select maybe the best dividend yield first, right? The most straightforward is which company pays off the highest dividend. Let's take a look at it first, right? So if you focus on this list here, you can see NHI, which is at the top of the list. It has a yield of 6.44%, which is the highest, okay? But just now I mentioned, right at the start of the webinar, in today's sharing, I say that don't just focus on the yield. That's a good starting point, but don't just focus on that, right? Why? We want to buy into only companies that are fundamentally strong. So with that, okay, we rank the yield, we go through the list, and let's say in this case here, we saw, all right, the NHI stock itself pays off the highest dividend yield, but we don't just invest because the yield is high, okay? We want to look into the fundamentals of a company. Now, the fundamentals, of course, includes profits, includes some metrics I'm going to share with you over here. Okay, we put them to the test, right? So I also designed a toolkit. I'll show you in the next slide. But the idea of this toolkit here is you input all the fundamentals data, and this toolkit, this calculator will calculate for you, okay, what is the fundamental score of this particular company. So anything above 15 is a fairly strong company, and I usually call it close to eyes, invest in them, you're safe, okay? Apple is actually there, right? Apple is a very strong company, but the dividend is not that good, okay? So anything above 15 score, strong. As I mentioned, quote unquote, close to eyes, invest in it, you're good, okay? Anything that has a score of less than 10, you can invest, but be very, very careful about it. Okay, so let's put that one NHI right into that toolkit and show you the score. Okay, some other additional kind of qualitative metrics that I look into. I also look into how consistent the company pays the dividend. Is it, you know, every year the company pays dividend? That's very important. If the company has been paying dividend for the past 10 years, past 15 years, or even longer, better. Okay, is the company growing its dividend consistently, right? Which means that for the past 10 years, every year the dividend is growing. Fantastic. Okay, so I look into that as well. And last but not least, I also look at the current payout ratio, okay, to analyze and say, is there any potential growth for this company to grow its dividend in the future, right? So these are some additional metrics that I look into as well. Now, putting NHI into the test, right? You realize that the yield is about 6.4%, but the score from a fundamental perspective is only 8. Okay, so what this means is that if I want to invest in this company for the dividend, I need to be very careful because this company might not be very strong fundamentally. Okay, in other words, I might not want to invest in it. I might want to avoid and choose a better one, fundamentally stronger company, so that I can sleep soundly at night, right? I don't need to worry about the company collapsing. Okay, now I'll give you an example. Another company that I've invested recently is GILD, Gillette. Okay, I think most of you will probably heard of this company. Okay, so I put this company into the toolkit. The scoring of this company is 12. Okay, it's still below 15, but it's above 10. Okay, so still acceptable, right? And then what I did is I also put this company, the next step is into what we call a valuation metric. Okay, valuation at the end of the day, if you want to understand it in a layman term, is what is the value of this particular company. okay, and we compare it to the current market price. If the value is $100 but it's trading at maybe $80, we are at a discount, right? Because the value is 100, but right now you can get it at 80, so it's a discount. If the value is 100 and the market is trading at 120, it's a little bit expensive, right? Because the true value, the reference guide is 100, but right now the market is trading at 120. You might want to wait a little bit. Okay, so that's a reference guide, what we call valuation. Okay, so if I put GILD into the valuation toolkit, again, a calculator toolkit that I've designed, we realize that the current IV, which is what we call intrinsic value of GILD, is about $124. The current price of GILD is about $62. Okay, so it's actually about 50% discount. What this means to you as a dividend investor is the fundamental is not too bad. It has good dividend. The valuation is great because we're at a super discount right now. So what this means? It means that today, okay, if you're building a portfolio, this company might be a good pick. Okay, and of course, based on the sector itself, GILD falls a little bit under the staple sector too, okay, which is one of the sector that we talk about. Okay, so all these processes you can see right from top down, we don't just anyhow invest and build a portfolio, right? We want to be selective. We want to choose only the best one out of it and put it into our portfolio. Why? Now, this here at the start takes a little bit of work, okay? But again, to build a passive income, you do your work once, you do it well. Keyword is do it well. And then after that, you don't really need to do much, right? You just monitor, okay? So that's the part where you realize at the start, a little bit more work, right? A little bit more steps in how we build this. Okay, so as I continue to go down the list, repeat the entire process, look at the fundamental, look at the valuation, look at some of the metrics and see if this company is good or not. Okay, that's where for me, I've personally chosen this 5 stocks. Okay, again, these are not telling you to go and buy it and invest now, but these are just suggestions, sharing with you what are some of the stocks I'm looking at, right? So we have GILD, WBA, MMM, which is 3M Co. I think this company you guys know. Cisco, CSCO, and then of course ExxonMobil, XOM, right? I think if you're following the market, you know that energy stocks are rising, okay, because of inflation as well. ExxonMobil falls in the energy sector and it's paying off good dividend. Okay, so these are the 5 companies I'm looking at. Okay, so if you put all this together, just now we mentioned 2 ETF, 5 stocks, right? So I've also designed a tool for me to track my entire portfolio easier, and more importantly, it's automated, right? So I call it the portfolio tracker. So what happens is I input all the stocks and ETF that I want to buy. This tracker here would tell me, right, based on a $1,000 portfolio, how many shares I need to buy in to have a good balance based on the allocation that we talk about, okay, which is 65% split out into 5 stocks, and then the remaining 35% on the 2 ETFs. Okay, so you can see over here, once I input all this based on the current market price, it will tell me today what are the numbers of shares to be investing into so that my portfolio is balanced according to that allocation. Okay, and over here, I just want to highlight also, right? Today, we focus a little bit more on the $1,000 dividend, but as you grow your capital, as your capital in terms of cash increases, there are different portfolios that you can construct. Okay, I'm not sure if you guys hear about the all-weather portfolio. It's actually devised by Ray Dalio. So if, of course, today you have a bigger amount of capital and you're a little bit more conservative, you might want to allocate a portion of your entire portfolio into the all-weather portfolio. Okay, so that will help you to reduce the volatility of your passive income portfolio. Okay, or if today you're a little bit more aggressive, then there are different portfolios you can construct as well to increase your potential income growth. Okay, so this is the whole idea. In terms of the processes, in terms of the steps, things that I'm looking out for to construct this portfolio, right? At least for the start, in terms of $1,000, right? How you can get started with a small amount of capital. Hopefully, you guys are still following through, yeah? Good. Okay, we're running a little bit short on time, but I want to still open up for Q&A. Give me a couple of minutes to conclude today's sharing, and then we'll see if you guys have any questions that you have for me, right? Okay, so to summarize a little bit, today we have covered, number one, what is dividend investing and why everyone should be building one portfolio for yourself or for your future generation. We talk about the mindset that you need to have. Why is this so important? Because it builds up the foundation for you to see your success in the passive income portfolio. Okay, and of course we talk about how you can get started with just a $1,000 capital, and I'll show you also what are some of the things to look out for, what are some of the metrics, right? And of course the tools over here that's designed to facilitate and automate all these processes. Okay, so what's next? Before we go into Q&A, also want to take this opportunity because today, together with Phillip Nova over here, we decided to give you guys a little bit of a special promotion, right? Again, all thanks to Phillip Nova for sponsoring this, right? So this is what I've designed. It's called the Dividend Mastery Toolkit. I'll share with you in a while what is inside, okay, what you're getting. But this current toolkit, if you go to the public website, I have it as well, but it's retailing at $94, right, in US, $94. But today it's only at $47, and potentially you can get it for free, right? Because together with Phillip Nova, okay, they've agreed to sponsor you, right? So if you want to find out a little bit more, you can also contact them and clarify a little bit. Hey, but over here, I want to share with you what you're getting in this Dividend Mastery Toolkit. Okay, first up, just now we mentioned about the portfolio tracker. Okay, so all these tools, they are designed and coded on Google Spreadsheet. And what you do is you download that into your Google account and you can use it forever. Okay, and the beauty about Google Spreadsheet is you can log into your own Google account on any computer and you can access that anytime, right? So all of this toolkit here is designed in such a way that you don't need any specific software. All you need is just a Google account, which is free, right? Most of you would have that, yeah? So the portfolio tracker is the first thing you're gonna get, which is important because it helps to track your portfolio. It tells you how to balance it, how to do portfolio allocation, right? How much share to buy, how much share to rebalance, and things like that. Okay. The second thing you're gonna get in the toolkit is what we call the Fundamental and Ddm Valuation, which just now I show you briefly, right? You input the data, it tells you the fundamental score of a company. You input the data, it tells you the intrinsic value of the company as well. Okay, so all these calculations are automated. You just need to input the data, which you can find it from investing.com or Yahoo Finance. Okay, today we didn't cover this, but in the toolkit we also have the Etf Mean. This is important because every about 7 to 8 years the market crash. Okay, while everyone panics, you want to use this calculator to tell you, is it a good time to be buying in, right? 2022 the market came down, but if you use the Etf Mean calculator, you realize that it's not the best time to heavily buy in yet. Okay, while this market is dropping, it's still actually above its mean. Okay, so this calculator, this tool helps you to kind of like psychologically tells you whether is it the best time to get in yet or not. Okay, so this is the mean calculator. Some other bonuses that's included inside includes the guide, the template to help you step by step how to construct your dividend portfolio, your passive income portfolio. Okay, we have a Facebook community for all dividend investors as well as a previous workshop that I share with. This is pre-recorded. Okay, it's a previous workshop that I share with fellow investors and show them in a live environment how I invested $1,000 together with them. Okay, and of course, moving forward, end of June, early July, we're gonna have another one which is live to update on this portfolio. What are some of the things we need to do, right? So this is actually more of like hands-on, step-by-step guidance in terms of how to construct, after construction, how we manage, what are we looking at to rebalance our portfolio, etc. Okay, and last but not least, recently I also added 3 portfolios for fellow dividend investors to use it as a reference, right? So you can see at the bottom we have the dividend cash flow, we have the income legacy portfolio, and we have the high yield stocks portfolio. Again, these are not meant for recommendation, they are just suggestion. Okay, but of course, I know many investors just basically follow and build their portfolio accordingly, right? You definitely can do that too. Okay, so these lists are always updated according to my personal portfolio. Whenever I invest in particular stock, I'll add that in. Whenever I get out rebalance of it, I'll remove it. Okay, so in a way, you can also use this to see what are some of the stocks I'm personally invested into. Okay, so to sum up, this is what you're gonna get in the Dividend Mastery Toolkit. And again, as I mentioned, together with Phillip Nova today, you're able to get it at just $47 and potentially free. Okay, it's sponsored by them. Good. I hope so far so good. Okay, we hit exactly at 8, but I want to at least allocate some time and see if you guys have any question. All good.
Thank you so much, Kar Yong, for succinctly wrapping it up for us. Well, right now we don't have a question yet, but let me just share with you. This course is discounted if you're a Phillip Nova customer. If you're not yet a customer but are keen to enjoy the special promotion, please do let us know in the survey form at the end of the webinar. We will also send details of the promotion in our follow-up email, which will be available on Monday, one working day later. But before, in the meantime, if you have any questions, please type them into the question box. It's located in your control panel somewhere at the bottom. Just look for the box and type your question in there. Kar Yong, I have a question for you just to keep things rolling. I just want to ask, you mentioned that you update the watch list very regularly with the stocks that you're following. How often will it be refreshed to show new data?
All right, the list is live, which means every time a changes is made, it will be updated. But for me, of course, again, the emphasis here is not trading for this portfolio itself. So what I do is on a month-to-month basis, I do relook at the portfolio and see if there's any opportunity to add it in, or if there's any stocks that perhaps doesn't really fit into criteria anymore, then we'll rotate out of it. Yeah, so it's actually going to be on a month-to-month basis. But having said that, it does not mean that every month there's definitely new stocks to be reinvested in. But what we do is we just look at them, manage it accordingly on a month-to-month basis. But that's me. I'm doing this full time, so I'm a little bit more active to that. Having said that, if today you build up your dividend portfolio, you select the stocks properly, you don't need to do it on a month-to-month basis. But what I suggest, minimum for all investors, at least do it on a quarterly or even max, maybe on a half a year basis, so that you at least keep in touch with how your portfolio is doing, and you can do the necessary adjustment accordingly. Yeah.
All right, Kar Yong, while you were answering the question, we have a few more questions on hand. Maybe we can do a quick fire round. The first question is from Emmanuel. He's asking, do you still need the chart to access in times of timing to enter the market?
Good question. If you are looking to time your entry, you can look into the chart, right? But of course, my focus as I'm building my approach towards this passive income portfolio, as I'm building this, I'm not trading it. So I'm not putting too much emphasis on the time itself, more towards managing my entire portfolio as a whole, because I'm looking at it for the long run, right? I know some of the audience would probably have some experience in technical analysis, and if you want to combine that, right, that would of course be beneficial to you as well, because you're able to psychologically be more confident in entering at the low price, and you might not see too much of a drawdown or volatility in your portfolio. So the answer to that is, I personally don't look into the charts when I'm building this portfolio of mine. But if today you have the knowledge and you prefer to look into the charts, you can definitely do that.
We are getting some really good questions here. I just want to say that if we don't pick up your question right now, we'll pick up your questions and send them to Kar Yong to address in the follow-up email. Okay.
Yeah.
The next question that we have is, all right, let me pick one of the ones that I think is very useful for everyone. Is it a one-time fee for the toolkit?
Yes.
All right, there you heard it from Kar Yong itself. It's a one-time fee. Kar Yong, very good sharing. Thanks. Do you combine dollar cost averaging to put in 1,000 monthly in your dividend portfolio?
Okay, my suggestion to dollar cost averaging is you need to have a very strong psychology and mindset to really do that, right? Now we do take that principle and apply it into dividend investing, but just now I mentioned one of the tool is called the Etf Mean Toolkit, which basically tell us, right now the market price, is it below the mean or above the mean? And when we talk about mean, we are looking at 50 years, 30 years of historical price data. And if today the market is actually below the mean, it's actually a prime time, a little bit counterintuitive, but in the stock market itself, is that if the ETF is below the average mean, is actually the prime time to be averaging in, right? But if the price of the ETF is actually still above the mean, even though if it's correcting, it's not actually the best time to be doing dollar cost averaging. So we do take that principle and apply it into our portfolio, but we do it slightly differently in such a way we don't do it on a regular month-to-month basis. But having said that, if today you're prepared to build up your capital by investing $1,000 maybe on a month-to-month basis or quarterly basis, you might not want to average in the exact same stock, but perhaps you want to consolidate a little bit, maybe in a year's time, you save up maybe 2,000-3,000, and then at one go, as you rebalance your portfolio, you put that amount in and rebalance it as a whole. That's my approach towards building this portfolio. But of course, this again differs for every individual. I did not include in today's slide, but in the toolkit itself, we also designed a personality test to help you, give you some suggestion as to how you should approach and build your portfolio according to your personality. So inside there are some suggestions on all this as well. Hopefully that can answer the dollar cost averaging.
Right, we're getting a full stream of questions. Let me just combine two now. We have one gentleman asking if for US stocks you need to pay 30% tax, right? So is that going to be eating into your dividends? Another gentleman asking, for US stocks you need to pay 30% tax. So why not SG stocks and REITs instead? What are your thoughts?
Okay, I get this question almost all the time when we talk about dividend investing in the US market. Yes, in a way, 30% is definitely going to be cutting into some of the dividend profits that you're going to collect. But if you compare it relatively, not to say that you can't invest in SG market or SG REITs, but if you just look at the potential of the dividend, yes, they are comparable. Okay, but as we invest into and building this portfolio of us, you do realize that I always emphasize on fundamentally strong company. In other words, 5 years down the road, 10 years down the road, you're not just going to see the growth in dividend, but you're also potentially very high chance going to see the growth in the capital, which means the price that you invest in a particular company 5 years down the road, 10 years down the road is going to be significantly higher. This one here, I don't have any chart prepared, but if you just take a look at the overall US market, S&P versus SGX, which is Straits Time Index, STI, you take a look at that two indices for the past 10 years, past 35 years, I think you can see the stark difference between how S&P has grown versus STI, right? So that is something that another reason as to why I think the focus will primarily still be US in terms of the potential there. But of course, if you want to go in both, right? That's also good, right? In terms of like rebalancing, allocation diversification, that's definitely doable. But I want to just highlight all the tools that we've designed, because a lot of automation, they're designed primarily for the US market, because data is readily accessible for my coding, for the formulas in Google, whereas Singapore market, a lot of the data I can't access into. Yeah.
Thank you, Kar Yong. Just one last question. Is the toolkit self-explanatory? Any support if we have questions?
Oh, all right. Okay, the toolkit inside, I have all the tutorials, which is video explaining how to use it. But of course, after watching the video, if you still need access, support, there is the Facebook group. But so far, all investors who are using the toolkit so far has no issue with that. So I hope the video tutorial inside is self-explanatory. Yeah.
All right, and there you have it from Kar Yong. If you have more questions, please let us know in the survey form at the end of the webinar. Once again, thank you for being a wonderful audience, and thank you so much, Kar Yong, for your time and sharing today.
All right. Thank you. See you. Bye-bye.
All right, thank you so much. Have a good night. Until our next webinar, we'll catch you then.